Hi. Most mortgage lenders are honest professionals. They know what they're doing, they know their business, and they know how to make the process go well. But there are occasions when buyers are given information that is incomplete, incorrect, and sometimes just plain wrong. And mistakes like that can cost thousands of dollars or put you in a bind that you can't get out of for 30 years or until you sell the house. So that's what we're going to go over here tonight. What are the errors that can happen in the mortgage process and who's to blame? I've been doing this over 20 years and I've worked with lots of lenders. And like I said, most of them do a really good job, but I've seen mistakes even from the best of them. So it's good for you to understand as the borrower a bit about the process so you can not be at the whim of someone who might make a mistake or could be actually on the other side of the coin and be dishonest. So I'm going to walk you through some things tonight that borrowers should watch out for and be careful of. Now, like I said, most lenders are ethical. No argument there. And the mortgage process is complex and complicated. But buyers should understand that there are incentives built into the process that could sway something in a different direction than you really want it to go. And you got to be careful of this. The lender's job is to close the loan. Your job is to make sure that the product you're getting fits your needs and doesn't put you over a barrel later. Now, one of the biggest traps is that the lender is going to qualify you for probably much more than you want to pay per month. Your income on paper says you could support a loan of $900,000. But should you borrow $900,000, you need to take a look at your budget, your lifestyle, and your plans and expectations for the years to come. You don't want to be house poor. That's a very difficult position to be in. You don't want to underborrow and get too small of a house that you have to exchange too soon because that can be costly too. But you don't want to put yourself in a position where you've borrowed more than you can really take care of and really handle on a responsible basis, especially if your plans include additions to the family, education, things like that. Sometimes this happens because of the automated underwriting system, which just spits out a number. It doesn't factor you as a person in. It's just spitting out a number from a computer algorithm. And that's fine. If you can afford it, great. But if you can't, it doesn't mean you have to borrow what the computer says you qualify for. You need to know there are financial incentives built into the process that benefit the loan officers. All these factors come together to make the process lean towards maximum approval rather than what is prudent or correct for your particular situation. Now, a really good loan officer is going to talk to you about this. He's going to go over your budget with you and he's going to ask you questions because he doesn't want to put you in a position where down the road or some point later or even sooner that you get into a financial bind. So a good loan officer is going to talk to you about your circumstances. So be careful to talk about this with your loan professional so he has the full picture. Now, here's another one. A common statement that you might be given by a loan professional is that don't worry about it now, rates will drop and you can refinance later. Well, maybe, maybe not. Used to joke and say, date the rate and marry the house. But we had a couple of occasions over the last bunch of years where that didn't work out to be the case. We had some periods of time where rates were a little higher and then they dropped significantly, and a lot of people refinanced. But we've had in recent times and about 15 years ago where that didn't necessarily turn out to be the correct or prudent thing to do because rates actually did go up or because the market fell to such an extent that you couldn't refinance because you were underwater. Refinancing depends upon a few key points. You got future interest rates, of course. They could go up, they could go down. Hopefully, they'll go down and you can refinance, but it is possible they could go up. Home values. We always hope that appreciation is going to occur in the neighborhood in which you're buying, but that isn't necessarily always the case from year to year. You could have some appreciation going on for some years, and you could have a flattening off or even a dip sometimes. Appreciation in a given area is not on a straight line. There are ups, there are downs. So you have to factor that in. Property values will affect your ability later on to refinance based on its value at that point as compared with now. And then, of course, there's always the possibility, hope it never happens, that your credit profile could change. Maybe you run into some medical bills that cut a little too deep, or there was some other situation, lost a job, or even had to take a pay cut. Sometimes this happens. So your credit profile could, in fact, change. So refinancing down the road may not be an option. And then, of course, there's the other factor of closing costs. On every loan, even if they promise you there are none, every loan has costs built into it. Nobody's going to lend you money at no cost. There are potential of transfer taxes, there are fees to the lender, there are titling fees, there are things like that. So there could be significant chunk of change that gets factored into this refinancing down the road, so that may not actually be worth your while with the cash you have to make an outlay of. So the old adage, if the rates are high now, you can refinance later, may be true, but it may not be. And there are several factors that will affect that over time. So be careful of that. Refinancing may be an opportunity, but it's never a guarantee. Some lenders will get you in the door by advertising some really, really great rate. I've seen certain credit unions and certain banks advertise a really fabulous rate that beats out all the competition until you look at the fine print. There are origination fees factored in. There could be discount points, processing fees, closing costs, all of that. You have to factor that in. Just because the rate is low doesn't mean the cost is low. And that is definitely something you want to take a look at. I remember a couple of years ago, probably closer to 10 or 12, where someone was shopping rates and they found a rate with a certain credit union and the rate was extremely low. And we checked it out. We got him qualified through them because his rate sounded so great. And turned out there was a big upfront cost to that loan. So when you factored in the upfront cost, we took a closer look and there were some pretty high fees associated with it. There was a certain amount of upfront interest that had to be paid to get that lower rate. And when you factored in the amount of interest up front compared to the interest saved over time, it didn't really balance out very well. So you have to watch for that. When you're comparing costs from lender to lender to lender, you want to compare the total cost and not just the interest rate. Talk to your lender about the APR, the annual percentage rate. That will tell you the rate of the loan plus the costs to get that loan. And if the variance from lender to lender is significant, you want to take a look at why. Another little trick that sometimes gets played is when you look at the estimate from the lender, you will see that the closing costs can vary significantly from lender to lender to lender. Now, you really need to know that the only things that the lender can tell you with any exactness are the fees associated directly with the loan, the interest rate, their origination fee, appraisal costs, that sort of thing. They can't tell you fully what the transfers are going to cost, what the title insurance cost is going to be. There are a lot of factors that are part of this overall estimate that can swing one way or the other because they are estimates. So when you are comparing lender to lender, make sure you're comparing apples to apples. Compare the rate, compare the lender charges, but ignore all the other estimated fees and charges because they may or may not even be accurate, and they can be shown to be lower just to make it look better, and you don't want to fall for that gag. Now, this may be obvious, but I'm going to say it anyway, is don't let a lender talk you into borrowing money that you actually don't need. Some of you out there have rather adequate investment portfolios, and that doesn't mean you need to liquidate them to make the purchase of a home, but in many cases, you can borrow against them at much more favorable terms, borrowing from yourself and borrowing from your own investment portfolio than you could ever get from a lender. So, one place to look if you have these sorts of resources is to look at them and any costs there might be and the ability to borrow against them to make the purchase of a home. It can be actually to your benefit in very big terms. In many cases, that interest rate alone is going to be lower. The mortgage underwriting process isn't even going to exist, so there aren't going to be fees and charges for that. And you can have faster access to your funds, so you could settle more quickly if that's what's needed. And if you're a reliable borrower, so take advantage of your own insights into yourself. And sometimes you may be able to not use a commercial lender and you can borrow from yourself at a much better set of circumstances. Also, if you have large cash resources, you can combine them with your investment portfolio and put a down payment, large down payment, borrow a little bit. There are different ways you can mix and match on this end of it. But if you don't need a loan, then what's the point? Why get a loan if you don't need a loan? Of course, realize that you should talk to your professional financial advisors, your accountant, those people to make sure you're making the right choice because If it isn't the right one, they're the best ones to tell you. Another thing to be careful of is if a lender is vague on whether they can meet the timelines required for the contract. And this is very important because the lender has no obligation. If they miss settlement, they've ticked you off, but it doesn't cost them anything. They may lose you as a customer, but they've got many, many more. So losing one probably isn't going to worry them very much. The loan officer may miss out on a commission, but he's got others. So you have to be really, really careful on this point that if you are, especially in a competitive market scene, you're actually getting a loan and they can meet the timelines and the deadlines as they're laid out in the contract, because you're the one that's going to pay the penalty. You're the one that could potentially have a financial loss because of it, not the lender. They have no contractual or fiduciary obligation to meet those deadlines, and you have to be really careful. If they won't answer your questions, press them. If they still won't answer your questions, you might consider another lender. Any lender that knows he can meet those deadlines and timelines will let you know, and he'll lay it out for you so you can see that it's reality and not just mush. Some of the problems with some of the bigger banks and some of the brokerage firms that deal with mortgages is that their underwriting team is not in the same area as the house being purchased. So there's a long distance communication line that has to be factored in. Sometimes the appraisers aren't close by. And so because of that delay and caused by distance, it can cause trouble at settlement. And that's something you really have to be careful of. The solution to all this is to use the local lender that knows the area and knows the customs of the local market. And that's the case. They want your business and they're going to make sure they do you right. And they hope that they get your business again down the road. Now, the next things I'm going to go over with you are really more errors on the part of the buyer, the borrower, than the lender. But a good lender will give you warnings so that you don't do this in the first place. It is not uncommon, and I've seen it a number of times over the years, where someone buys a new car shortly before settlement or changes jobs. These things get kind of glossed over by the average person because they're not considered that they would have an impact. If I'm paying out $300-400 for a car and I've already got good credit and I've got plenty of money, then what's the deal? If I change job, why does it matter? Because I'm actually making more money. But both of these things can result in a big monkey wrench into the system and cause big problems, delay settlements, uh, shut down the whole transaction, and you don't want to have to deal with that. So don't make those mistakes. Make sure that you keep everything status quo throughout the time that you're in the loan approval process. But you want to find out from the lender you're using that they know about this and that they are communicating to you about this. So they're warning you so you don't step into a puddle that you don't have to step into. So, as I said, there are tons of very reputable and very fine mortgage lenders in the area. I have several that I work with and I work with routinely, and I know they're going to get the job done. There are some that are not so good. And there are some that you can't even see because they're all online. So you have to be careful. The loan aspect of your transaction is very, very important. And changes that could result in loss of money and loss of a transaction do happen. And you have to be careful. There are ways to avoid that. But if you don't know them, well, you could be in trouble. So don't rely solely on the lender's numbers. Do your own due diligence on your own budget so you know that what you're borrowing is good and right for you, and compare the total loan costs, not just the rate. One rate may be lower in one bank, but the cost may offset that substantially. So you want to know that up front, and don't be misled by just the promise of a really good rate. And consider all your options, your investments, your investment strategies. Talk to your financial people when it's appropriate and get the overall best deal for yourself using whatever assets you may have and whatever loans you may need. The loan process has streamlined over the years. It's much simpler, it's much fairer, but it still has its pitfalls. And I hope you got something out of this to watch for them and prevent them from happening to you. Enjoy your new house.